Everything you need to know about the self-directed IRA in 30 minutes or less. Hey everyone, I'm Adam Bergman, tax attorney, founder of IRA Financial. And the real purpose of today's video is to give you the basics, but also the key details of what is a self-directed IRA, why it's so important, how it works, all the rules you need to know, and of course, adding in all the IRA basics. So you absolutely will know, once we're done with this video, everything you need to know about the IRA world and the self-directed IRA world. So this is an important video if you are a beginner, kind of never had much exposure to IRAs or self-directed IRAs, but this will also be a really interesting video if you have moderate to advanced knowledge of self-directed IRAs, because I'm still going to get into the prohibited transaction rule, UBIT, and also the different types of self-directed IRA. So I really think it's a video for anyone interested in self-directed IRA. So why you should be watching me? Well, I'm Adam. I'm a tax lawyer, founded IRA Financial 15 years ago. I've written 9 books on self-directed retirement accounts. I have a master's in tax law. I've worked at some of the largest law firms in the world practicing tax law. So you're going to probably come across lots and lots of videos in this space on IRAs, self-directed IRAs, Roth IRAs, and a lot of the folks are going to tell you why you should listen to them. But I can tell you there's no one in the country that knows this stuff better than me. Not to say that I'm the smartest guy in the world. You can ask my wife. I barely can turn on Netflix. But when it comes to tax law, self-directed IRAs, and IRAs, I know everything there is to know. And I promise you, give me 25 more minutes and I'm going to tell you everything you're going to need to know so you can be as smart as me. So let's start with the basics, right? Before we get into the self-directed IRA world, let's start with the basics. What are IRAs? So IRAs were created in 1974 by ERISA, Individual Retirement Account. That's what an IRA is. And before 1974, just a quick history lesson, you didn't have access to really any type of retirement account to save unless you worked at a big company like Ford, because only big companies had retirement plans, which were known as defined benefit plans. So if you didn't work at a big company, you were locked out of the retirement system. Congress realized that, hey, we need to make sure Americans have money to save. We don't want them to be a burden on us. We want to make sure they have money for their future. So we're going to create incentives for them to save. And they created the traditional IRA, SEP IRA, 401k, simple IRA. The Roth IRA was created in 1997. So let's focus on the pre-tax IRAs. And the idea of the IRA, the SEP IRA, and the 401k is let's give incentives to Americans to save. Why? Because we love to spend. Americans don't love to save. So let's encourage Americans to save. So what they did is they said, okay, if you contribute to an IRA, you're going to get a tax deduction, which is going to lower your tax liability, which is a big attraction. And number 2, probably more importantly, we're going to take advantage of the power of compounding returns, and we're going to let the money grow in the IRA without tax, right? And if you know anything about mathematics, your money is going to grow faster when it's not subject to taxation. That's the rule of 72. Assuming a 9% rate of return, your money will double every 8 years. Albert Einstein said compounding returns is the 8th wonder of the world. It's how smart people get rich. So when you add in the deduction and the power of deferral, you see why the retirement system is such a valuable tool to save. In 2025, there's approximately 65 million IRAs, but $17 trillion in IRA money, and overall around $34 trillion in retirement money. So Americans get it. We're smart, and we know the best way to save is through a retirement account. So let me just touch on some of the basic stuff. Traditional IRAs, in 2025, you can put away $7,000 or $8,000 if you're over 50. There are some income limitations, but you do get a pre-tax deduction if you qualify. And the income limitations are generally tied to if you have access to a 401k at work. If you take money out before 59.5, pay tax and a 10% penalty. Pull money out after 59.5, just income tax on whatever you pull out. But at age 73, you have to take what's called required minimum distributions, which is approximately 3% of the asset value. So it's a really great retirement account. It's the most popular type of IRA. And generally, if you don't have access to a 401k at work, you're going to generally make deductions and contributions through an IRA. For example, if you're single and you make less than $89,000, you can do an IRA which is very important. If you're married, file jointly, and you make more than 146,000, and your spouse has access to a 401k, the number goes up to 246. Whereas if you have access to a 401k, it's 146. So generally, as I mentioned, it's the limitations, but it's based off whether you have access to a 401k at work. The Roth IRA, which is my favorite, I wrote a book, In God We Trust and Roth We Prosper, created in 1997. The difference between a Roth IRA and a traditional IRA is you do not get a tax deduction for a Roth IRA, but so long as you're over 59 and a half and the Roth's been open for at least 5 years, whatever you pull out is tax-free. So that means if you invested $5,000 in Bitcoin in 2005, I should say 2015, and now it's 10x, you can pull everything out you want tax-free. Whereas if you did it in a pre-tax IRA, you'd pay tax on what you pull out after the age of 59 and a half. Whereas if you did in a Roth, so long as you're 59 and a half and the Roth's been open at least 5 years, it is all tax-free. So that's super exciting. There's no requirement of distributions, and all contributions you make, you can pull out anytime without tax since they're after tax. There are some income limitations, 246,000 married filed jointly, 165,000 single. But even if you make more than that, there's a workaround called the backdoor Roth IRA, where you simply make an after-tax contribution and then just convert it to Roth. So really, anyone can do Roth IRAs, even if you're Bill Gates or Jeff Bezos. The SEP IRA is essentially a pre-tax IRA like the traditional IRA, but it's an employer plan. So only a business can set it up. It's a pure profit sharing plan. So the max you can put away is $70,000 in 2025. And if you're a sole proprietor or single member LC, it's 20% of your net Schedule C up to $70K. If you are a W-2 employee of a C or S Corp, 25% of your W-2 up to $70K. There's no catch-ups if you're over 59 and a half. You can do pre-tax or Roth. There's also RMDs. So it's a good company plan, but really the 401k is a far more popular plan because you can do employee deferrals, which is dollar for dollar, and the profit sharing. Whereas in the SEP, it's just a profit sharing. So if you made 100K, sole proprietor, the max you put away is 20K. Let's just go quick to the simple IRA, and then we'll get into the fun stuff of self-directed IRA investing details and going through some of those interesting concepts. So the simple IRA, again, it's a poor man's 401k. You can put away $16,500 plus a catch up of $3,000 if you're over the age of 50, or excuse me, $3,500 if you're over the age of 50. I say it's a poor man's because in a 401k, you can do $23,500 or $31K if you're over 50. So you can put away a lot more in a 401k. You also get the loan feature, and most people want to max out their 401k if they can. So the 401k is a far more attractive plan than the simple IRA. But the simple IRA, you can do pre-tax or Roth. There's requirement of distributions. I would say the only advantage for setting up a simple IRA is the individual accounts could be segregated. So you have an easier chance to do alternative assets, and the employer doesn't have to do the administration. The IRA custodian, i.e. IRA Financial, would do the administration. So it's less of a burden on the company. But otherwise, it's not very common because you can put away a lot less than a 401k. So now you know everything about the IRAs. So we talked about traditional IRAs, pre-tax, right? 7,000 or 8,000. Roth IRA, Roth, after tax, 7,000 or 8,000 if over 50. SEP IRA, pre-tax profit sharing plan. 20% if you're self-employed, 25% W-2, max $70K. Simple IRA, pre-tax or Roth, business has to set it up, $16,500 or $3,500, plus $3,500 if you're over 50. Again, the SEP IRA and the simple are basically not as common as the 401k, but they're options. All those IRAs I just mentioned could all be self-directed, okay? So what does the word self-directed mean? The word self-directed you will not find in the tax code. Doesn't exist. Why? Because all IRA should be self-directed. And that's what IRA Financial is all about. There is no reason that Vanguard or Schwab will not let you do alternatives in their IRA. No reason. It's a money decision. Now that we know what a self-directed IRA is, let's go through some of the benefits. And I just kind of touched on these, but obviously it's growing your money without tax, right? It's diversification. It's being able to create legacy wealth, and not just legacy wealth, but tax-free legacy wealth. It's about investing in what you know, investing in what you trust, having control, and not letting Wall Street dictate what you can invest in. So there are two types of self-directed IRAs. There is a traditional self-directed IRA that I call a custodian-controlled self-directed IRA, and there's a self-directed IRA LLC. The self-directed IRA trust is basically a follow-up of the LLC, and instead of an LLC, there's a trust. But let's focus on the regular self-directed IRA and the self-directed IRA LLC. And you can see through the flow chart, there's really three steps to the self-directed IRA, right? The first is you open an IRA, and you're not going to be able to open a true self-directed IRA at Schwab or Fidelity. Why? They don't want you doing alternatives because they don't make money when you do alternatives. So you go to a company like IRA Financial, you open an self-directed IRA, we have flat fees, it's easy, quick. And once that's open, you can roll money in tax-free, right? From a 401k, former employer 401k. You can transfer money in from an IRA, a SEP IRA, a simple IRA, a Roth IRA, or you can make a contribution to the self-directed IRA, right? The $7,000 or $8,000 if you're over 50 for a traditional IRA, a Roth IRA, SEP IRA up to 70K, simple IRA 16.5 plus a $3,500 catch-up if you're over 50. So once the self-directed IRA is established, you do your transfer rollover. It's all tax-free. You don't pay tax moving from an IRA to an IRA. As long as you're going institution to institution, you can do it as many times as you want, or from a former employer to an IRA, unlimited, tax-free. And then once the money's in your account, simply tell IRA Financial where to send the money. Now, IRA Financial, we are a self-directed IRA custodian, okay? So in order to have someone invest your IRA, they either need to be a bank, financial institution, or a state chartered trust company. IRA Financial is a state chartered trust company. We don't sell investment advice. We don't sell products. We are 100% your partner. We're neutral to the investment. We're agnostic to the investment. We have flat fees, so we want you to make a lot of money. We don't make more money as your assets grow. Unlike some of our competitors, some of the other folks in the IRA industry, we have flat fees. So as your money grows, which it will, if you look in the S&P 500 over the last 100 years, it's averaged over 10%. Your money will grow. The reason to do a self-directed IRA is to do better than 10%, right? You want to diversify. You want to not just gain exposure to traditionals, but you want to also complement that with exposure to alternatives. That's how you try to generate higher returns than the S&P 500. So again, step one, you open the self-directed IRA account. Step two, you move the money in tax-free, penalty-free. Step three, you just tell IRA where to send the money. Hey, send it. I want to buy real estate. I want to buy gold. I want to buy Bitcoin. I want to do private equity. We send it, title to the investments in the name of the IRA. We do all IRS reporting, the administration, the record keeping, all the IRS filings. So you have to do nothing when it comes to IRA and IRS reporting. We do it all. And that's where our fee comes in. You get to focus and do what you do best, which is invest and have fun doing it. So that's the traditional self-directed IRA. It's the most common. If you're not doing a lot of transactions, you're just going to maybe buy some land, buy some gold, some Bitcoin, do a kind of private equity or venture capital investment where there's a lockup period, maybe invest in a private business. The self-directed IRA is a great, great, great opportunity. Very cost effective, very easy. The self-directed IRA LLC is essentially the IRA structure, but adding the LLC component. So let's go to the flow chart, right? Step one is the same. You set up a self-directed IRA with IRA Financial. Step two is the same. You roll money in tax-free. Transfer, rollover, it's tax-free, penalty-free. Step three is the same, okay? The only difference in step three is that once the money is at IRA Financial, instead of IRA Financial sending the money to the seller of the real estate, IRA Financial is going to send the money to a special purpose limited liability company, an LLC. And that's an entity that IRA Financial sets up for you. We'll set up the LLC, we'll do the tax ID number, we'll do the operating agreement, we'll do all the state filings. And what does the LLC do? Okay, so before I get into what the LLC does, let me just double click on what an LLC is. So an LLC is a limited liability company. It's a pass-through, okay? So an LLC doesn't pay entity level tax. Think of it as like a funnel. It's an invisible thing, okay? So if the LLC creates $100 of profit, The LLC does not pay tax on the $100. The owner does. Whereas look at a corporation like Apple Inc. Okay. How do you know an LLC versus a corporation? If you see corporation or Inc. at the end, it's a corporation. If you see LLC at the end, it's a flow through. So let's say Apple Inc. makes $100. Apple Inc. pays $20, $21, 21%. That leaves it with $79. And then that $79 gets dividended up if the company issues a dividend to the shareholder, and the shareholder pays tax, let's say 20% on the $79. And now it's left with 79 minus around 15. So it's left with like, let's say $65. But if the LLC earned $100, it would pay no entity level tax. The $100 would flow up to the shareholder and it would pay, let's say 20% tax. So it'd be left with $80. 80 is more than 65. And that's why LLCs are so popular. But here, IRAs are the owner of the LLC. And we know an IRA is tax exempt, right? One of the beauties of an IRA is it doesn't pay tax. We talked about the power of compounding returns. The beauty is all the income and gains generally in the IRA flows back to the IRA without tax. So having the LLC be owned by an IRA, what happens is the IRA invests in the LLC. The LLC then buys the real estate or buys the gold or buys the Bitcoin or buys the private equity. And all the income and gains from that investment flows up to the LLC, right? You see it goes LLC, and then the LLC doesn't pay tax on it. And because IRAs don't pay tax, there's no tax. So you have this LLC in the middle of the transaction, right? You have an IRA, you have an LLC, and then you have the investment. But because the LLC is a tax invisible, doesn't exist, you don't pay any tax, but it gives you what's called limited liability protection, which is super important, means all the assets outside of the LLC are protected by creditors. So God forbid there's a fire at the house and something horrible happens, any creditor cannot go after your assets outside of the LLC. It also gives you privacy, right? It's much harder to find out who owns the LLC. Okay, so if you're going to be doing a lot of investments, what the LLC does is also gives you control. And that's where the name checkbook control comes in. Why? Because you as the manager of the LLC have control. So the way the LLC is set up, and just consider it a triangle, the owner, the member, is the IRA. The manager, the person responsible for writing checks or making all decisions, is generally the IRA owner, me. And I have control to pay taxes, to pay Joe the plumber, to pay Jim the landscaper. I can do all that. Paul the painter. I don't have to go back to IRA Financial and have them do that, which would be the case in a regular self-directed IRA. So let's do an example. I think an example best serves how this stuff works. So if you look at a regular self-directed IRA, I have $100,000 of Fidelity and I want to buy a house in my neighborhood. Okay. So let's say I did the regular self-directed IRA, and I'll just show the flow chart. Okay. So I open a self-directed IRA with IRA Financial, and I then move the 100 grand tax-free from Fidelity to IRA Financial. And then I go on the IRA Financial app website and I upload information where I want the money sent. I give them the real estate closing documentations. IRA Financial signs it. They send them the money, and the title of the real estate's in the name of the IRA. All the income and gains from the real estate will go back to the IRA tax-free. But if I have to pay Paul the painter to paint the house, I have to ask IRA Financial to pay Paul the painter, okay? Which is not a problem. You go in, you fill out an expense report, payment request, and we'll send it the next day. Not a big deal. You have to pay taxes, same process. So the regular self-directed IRA is great if you don't have a lot of transactions. Let's do that same investment, but instead of IRA Financial buying the house directly, IRA Financial funds an LLC. The LLC is owned by my IRA, and then the LLC buys the house. Title to the house is in the name of the LLC. You can call it anything you want. We'll help you form it. We'll tell you where to set it up, what state, how it works. Don't worry. And then you'll get the privacy, you get limited liability protection, and you as the manager will have checkbook control. So now you got to pay Paul the painter. I have a checkbook. I write a check to Paul the painter. I don't have to bother with IRA Financial. I get more flexibility, more control, and more efficiency. So if you're going to do high volumes of transactions, you want privacy, you want limited liability protection, especially real estate, the LLC is going to make a lot of sense for you. And I was one of the first to set up Self-Directed IRA LLC structures. I wrote a number of books on it. So it's a really good, really good solution. That's what I use. That's like my go-to for doing anything is the IRA LLC. Yeah, this regular self-directed IRA works great, but I like having more control, more flexibility, and more limited liability protection. Okay, so in the next 5 or 6 minutes, I'm going to touch on prohibited transactions and UBIT, and we're going to wrap up. So now that you know all the IRA basics, you know the two types of self-directed IRAs, the self-directed IRA and the LLC. Now let's get into what you can't do. And thank God there's only 3 things you can't do with a self-directed IRA. That's it. Here they are. You can't buy life insurance, and you can't buy collectibles. Collectibles are like art, baseball cards. Why? IRS felt very difficult to value. There is a special carve-out for pure precious metals, gold, silver, palladium, American Eagle, state minted coins, but all metals, all IRS-approved coins must be held in the physical possession of a U.S. trustee. Okay, so you can't hold them at home. Otherwise, you can do it. Now, life insurance, you can't buy in an IRA, but you actually could buy in a 401k, which I'll tackle in an upcoming masterclass video on the solo 401k. Okay, the third category of prohibited transactions, the broadest, is found under Internal Revenue Code section 4975, and here it is in the sum. Whatever your IRA does must 100% exclusively benefit your IRA. So you can't have any personal benefit from your IRA, or either could any disqualified person. Disqualified person is a parent, child, spouse, daughter-in-law, son-in-law, or any entities 50% or more controlled by such persons. So I can't buy a house and live in it. I can't take my IRA, buy my kid a watch. I can't take my IRA, buy my wife a car, right? Whatever my IRA does has to 100% exclusively benefit my IRA, right? So here's a couple examples. Could I use my IRA to invest in Apple? Sure. Why? Because as long as there's no disqualified person, there's no prohibited transaction. So who's not disqualified? Brothers, sisters, aunts, uncle, cousins, stepkids, friends, obviously colleagues. As long as it's not a parent, child, spouse, daughter-in-law, son-in-law, or any entity 50% or more controlled by such persons, you can do it, right? So that leaves you really almost an unlimited world of investment opportunities. From private equity, hedge funds, venture capital funds, credit funds, private businesses, gold, Bitcoin, you name it, you can do it, other than life insurance, collectibles, and self-dealing prohibited transactions. So before I jump into UBIT, let me just kind of real quick just mention fees matter. So my suggestion is you do not want to work with a company that's going to be charging you asset valuation fees on your assets. Why? Because IRAs are going to go up. And again, what is this account called? It's called a self-directed account. That means you're doing all the work. So why should the company make more money as you make smarter investments? It's really ridiculous. So fees matter. The reason that there is leakage and you're not going to be able to maximize your returns is because you're paying too much in fees. So you want to be looking for flat fees, low fees, and you want to be making absolutely sure that you're working with companies that have the expertise to not only set this up, but help you administer it, record keep it, and keep you in compliance, which is one of the things I'm most proud of with IRA Financial is that we have an amazing and robust and really the industry's only full service compliance where we handle all tax reporting, tax filings, and tax research / compliance for the self-directed IRA and 401k world. So the last thing I'm going to talk about in the last 2 minutes is unrelated business income tax, or UBIT. It's an ugly 4-letter word. It doesn't impact most IRA investors, so don't worry about it. Generally, if you generate capital gains, rental income, interest, dividend, royalty income, the bulk of what you do passively in an IRA, obviously it's not subject to tax, right? IRAs don't pay tax based on section 401, 501, and 408 of the tax code. Retirement accounts do not pay tax. However, there's only 3 instances where this UBIT, this unrelated business income tax, applies. And the name kind of doesn't make any sense. Why? Because an IRA shouldn't have an unrelated purpose, right? Its only purpose is to make money. Whereas a charity like a hospital obviously has an exempt purpose, right? To save lives. And an unrelated business would be, let's say the hospital sold bicycles. Well, that's unrelated to its exempt purpose. Well, maybe we should tax the hospital because that's not fair. And that is the basis for the UBIT rules, which came back in the 1950s in the tax code. But unfortunately, IRAs are treated like charities and they're both tax exempt. So these rules apply to IRAs, even though they're not fair. So just the only thing you need to remember is there's only 3 instances where UBIT can get triggered. Using leverage to buy an asset, to buy stocks, for example, to buy real estate. And we know if you use a loan to buy real estate, the loan must be non-recourse. Non-recourse is a loan you do not personally guarantee. Why? Remember, 4975, the prohibited transaction rule says you cannot benefit in any way from your IRA assets. So you cannot personally guarantee an obligation of the IRA. So you can use your IRA's collateral, for example, because then you're using your IRA to personally benefit yourself. So if you use a loan, it has to be a non-recourse loan. But if you do use a loan to buy real estate or to buy stock, the UBIT tax can get triggered based off a percentage of the debt. The highest UBIT tax rate is around 37%, which follows the trust rates and gets triggered at a pretty low threshold, around $15,000. So let's say you borrow $50,000 and put in 50,000 K to buy a house of 100 K. Your debt to equity ratio is 50-50. That means if you generated $20,000 of profit, 10,000, which equals the debt to equity ratio, would be subject to this UBIT and it can get triggered. The second, so those are the first 2. Use leverage to buy stock. When I say leverage, I mean non-recourse. Non-recourse to buy real estate. And then the third is if your IRA invests in a business, like a restaurant, that's owned through an LLC. Remember, I talked about prior that an LLC is like a triangle and a corporation is like a box. The UBIT doesn't apply to corporations like Apple, Tesla, and 99.9% of all publicly traded companies. Why? Because the corporation already has a tax, the 21% corporate tax. So there's no point of imposing an additional tax on the corporation. The LLC is a flow through. So there is the need, at least in the UBIT world, to impose this like penalty on this LLC. So just remember, if your IRA is investing in a restaurant and the restaurant's an LLC, not a corp, there could be UBIT. Now, the importance of working with IRA Financials will help you navigate the rules. There's workarounds. There's something called a C Corp blocker, a foreign blocker. We can help restructure the investments. So again, this goes back to where I talked about fees matter. Yeah, you want to make sure you're using the right company, you're paying flat fees, but you're also working with a self-directed IRA company that's not just going to set this up and like collect your money and never be there to help you. They're going to help you strategize. They're going to help you customize. They're going to help you examine the investment to find out the best way and most tax efficient ways of doing it. We're pretty much the only company in the industry that can do this. Our expertise is unmatched, and that's why we've been able to help 27,000 accounts invest over $4.5 billion in the last 10 plus years. Why? Because of our expertise and experience in not just setting this up, but really holding your hand, making sure you're doing this right, you're doing it the most tax efficiently. And the beauty is we're your partner. We're not trying to upsell you products. We want you to succeed. We want you to do it in the most tax sufficient and efficient way and the most tax efficient. Well, we want you to do this in the most tax efficient way and the most cost effective way. That's why we have flat fees. So not only are we going to help you set this up, we're going to help you manage it. We're going to help you customize it. We're going to help you keep in IRS compliance. And then obviously, as the structure and the investment continues, we're going to help you record keep it and handle all tax filings and reportings and keep you in good compliance. So fees matter, knowledge matters, and the ongoing support, which is so crucial. A lot of people are like, Adam, I found a company that's $100 cheaper. I said, okay, I get it. There are some cheaper companies, but are they going to offer you any ongoing support? Are they going to do any of the tax filings? File in the 990Ts, the 1065s? Are they going to help you set up C Corp blockers? Are they going to help you navigate UBIT, navigate prohibited transaction, help you find workarounds? No, we don't have to hire lawyers and CPAs. We are them. We can do it ourselves in-house, which is why we are the best in the business when it comes to self-directed IRA. So I don't want to go too far. I think this is enough. 30 minutes. I try to keep this video pretty succinct. I can talk about this stuff for 10 hours a day, trust me, and I'll do more videos that are far more in depth. But I think if you've watched this video, you may want to rewatch it. This is everything you need to know about the self-directed IRA. I covered all the IRA basics. I covered what a self-directed IRA is, different types of self-directed IRAs, why you want a self-directed IRA, the prohibited transaction rules, the UBIT rules, some of the fee issues when it comes to self-directed IRAs, and then ultimately the idea of how you put all this together, right? You want to think about control, flexibility, and you want to, most importantly, embrace freedom. This is how smart people get rich. They save in a retirement account, they look to diversify, and they gain exposure and access to investments that they know and trust. And that's what we do at IRA Financial, is we empower you to save and invest in what you want and have freedom, and then ultimately be able to retire comfortably. So that's it. Thank you guys for watching. Hope you enjoyed the video. There's more to come. I'm going to kind of do these masterclass videos for additional topics in the upcoming months. I've been told by lots of clients, hey, can you kind of give us more in depth? Not too long. We love you, Adam, but like 30 plus minutes is enough. And give us the basics, but also dive into some of the details that we're going to need, so we feel like we have enough ammunition to go in and set this up and be comfortable and savvy investors. And this is what this video can do. But even if you watch the first 5 minutes and say like, I don't have time for this, don't worry. We'll help you. IRA Financial handles all this stuff for you. Our team will teach you all this, okay? We have an incredible sales team, incredible customer service team. You can call up and say, hey, I watched this video. I want to set up the self-directed IRA. Here's my fact scenario. Can I do it? What's the best way of doing it? What do you think? We will help you. So beginner, medium, advanced self-directed investors, hope you enjoyed the video. Thanks for watching, and hope to see you on the next video.